rates on mortgages are coming down despite the fact that the gloomy Bank of England held interest rates this month because the lenders are expecting a rate cut by August. So maybe next month, maybe in August. And we shall see. The Bank of England held rates at 5.25%. That's the base rate, despite the fact that they've already reached their inflation target. What was their inflation target? 2%. Well, inflation is just around 2% at the moment. So they're boasting at 1 minute, yes, we've reached our target, look what we're doing to the economy. And then the Bank of England hold rates. So if they do come down in July or August, it's not going to be enough to save the Conservative government, I'm afraid. And it looks like we'll have a Labour government very, very soon. But the good news is that lenders are anticipating a rate cut. Therefore, they're starting to cut rates in order to, I guess, to win business. The market is a bit slow. I was at an auction just this week, and the room was half empty. It was right in the centre of London, and I went to an event afterwards, and people were saying, "Well, it's the election. People are not sure what to do before an election because they're not sure what's going to happen." But in my opinion, this is like, you know, the most surefire election I've ever seen. I mean, Labour are like 20 points ahead in the polls. Conservatives seem to have run out of ideas. So I don't know what the uncertainty is. Everyone knows there's going to be a Labour government. It's just depend on by what size of majority. So I don't think that's stopping people. I know that commercial lending is down, according to a commercial broker friend of mine, Paul Rogers. But you know, he said this all goes in cycles. But definitely the market is a bit slow. There were a lot of unsold lots at the Barnard Marcus auction this week, just yesterday. So that's a good time to go and pick out the bargains. In an auction, generally a property has a reserve, and if it doesn't reach the reserve, then the auctioneer will say, sorry, that's failed to reach the reserve. If it reaches the reserve during the bidding, he would normally say, well, it's now in the room, which means, you know, any bids you make will be accepted if the hammer goes down. Because they start off, to get the room going, they start off saying, you know, if say the reserve is 70, they'll start off at a guide price of say 50. They'll go, anybody give me 50,000? Nothing. Anybody give me 45? Nothing. 40. And then someone, oh yeah, I'll give you 40. They're not going to get it for 40 because it's not even anywhere near the reserve. And then someone says, well, if he's going to give 40, I'll give 45. And then it starts 50 and 55 and until it gets to the reserve, and then it's sold. But if it doesn't sell, it goes to back in the room, and then if you're in the room itself, you can go to the back and say, what about that unsold lot there? What will they take? And let's say it didn't reach the reserve of 70. They might have the seller there. They might be able to get him on the phone and say, well, would you take an offer of 65? And he might say yes, because he needs to sell it, or they need to sell it, or the institution needs to sell it. And it's a good time to pick up bargains if you see there's unsold lots. And you'll get a list of them anyway. And when you buy, it will still be under auction conditions. So you don't have months to do it. You know, you're exchanging there, you're putting your deposit down. The first one to put the deposit down gets the property. And you really can pick up some bargains, rather than when everyone's bidding on something and it goes up and up, it goes at a ridiculous price. So things have definitely slowed down. Now, there's another report out this week saying that the average cost of a first-time buyer mortgage has exceeded £1,000 a month. It's gone up by 60% since the last election. This is obviously because of higher interest rates. Now, some of you might be thinking, well, £1,000 a month, that's not a lot. But yeah, that's not a lot in around the London area, but it's a lot, you know, if you're buying up north, for instance. So it shows that rates are you know, hitting people, and the cost of living and the cost of and arrears are up, as we know. So that's just a little fact for you. But another fact is that someone wrote a report the other day saying that the average income you needed to buy an average property in the UK was now £60,000. So you need about £60,000 as an income, as a single person, to be able to get a mortgage big enough to buy a property. So £60,000 will give you a mortgage of between 3 and 4 times that amount. So between, say, 180 and 240,000 as a mortgage. And because of the rising prices all over the country, that's what you'd need. Now, that's not going to get you a flat in Kensington or in central London, or even around the London area, unless you bought, you know, a real rundown ex-council property somewhere. But it will get you on the ladder. But 60,000 is quite a lot of money. It's probably around twice the average national average income. And you know, if you're earning 60,000, then you're probably near the top end of the income levels. So if you're earning 60,000, I'll just look this up actually, because I was looking at this the other day. How much does 60,000 give you? I think to be in the top 10%, you'd need around 68,000 to be in the top 10%. And there's actually an app you can go to which will tell you if you're in where your income sits in terms of the national scale. And if I can find it again, I will give you the name of the app. It comes in an article by the Telegraph called "What Does It Take to Be Rich?" Do you feel rich and that sort of thing, and it shows you what income is needed now to feel that you are rich. And it used to be around 100,000 a year. Now it's more like 200,000 a year. So if you put in here £60,000 a year, submit that, and it says you earn more than 87% of the people in Britain. So 60,000 puts you almost in the top. Can you see that? You earn more than 87% of the people in the UK. So to earn 60,000, you're almost in the top 20% of income, and that's what you need to buy to get. And that's the point I'm getting to, is that you need to be almost in the top 20% of earners in the UK just to be able to get a mortgage on an average property in the UK. If we put in a slightly higher income there, let's see what that comes out to, because these incomes are not earned by everybody. If you think about an average sort of office job or a job working in a shop, or the average sort of jobs are not earning, they're not paying that sort of income. If you earn 68,000, which is not much above that, 90% of you would earn on 68,000 a year, you'd be in the top 10%. You'd earn more than 90% of people in the UK. So sorry, the other one at 60,000 is 87%. So you'd be like in the top 15% of earners in the UK, not 20%. Does that make sense? So that shows you what you need to be in that top level of income and to start to feel rich. Because people from abroad often say, "Oh, that's a lot of money, 30,000," but it's not a lot of money when you're in the UK, especially around the London, because that's where most of the big salaries are. It's not a lot of money after tax, for instance. I mean, 100,000. I'm not sure what you would get after tax for that, but maybe 60,000-ish, 5,000 a month. Yeah, that's quite a lot of money for a lot of people. But if your mortgage is £2,000 and you've got a Porsche outside on the drive and the payments on that are 1,000 a month, you can see how it can easily be used up. But on 100,000 a year, you would earn more than 95% of people in Britain on 100,000 a year. Okay, and that's on the app. So to get in the top 10%, top 5% of income earners in the UK, 100,000 a year. Okay, and you can find that on the Telegraph. I think the article was called "What Makes You Rich?" or "How Does It Feel to Be Rich?" So just check that out. Have a look at that. Okay, so income-wise, yes, if you are living in, say, the Philippines at the moment, then you're going to say, well, 30,000 is a lot of money. Well, it is if your cost of living is like the Philippines, and you could get 30,000 if you were retired in the Philippines and you had a pension giving you passive income of 30,000 a year. Of course, you could live really, really well there, even if you're renting a place on the beach or in the city centre. You could live really, really well on that. Same in Thailand or Malaysia, or in a lot of these countries. You can, and a lot of people do retire to South America, to Puerto Rico and these sorts of countries, because they've got pensions paying them in dollars or pounds, and then they can spend in the pesos of the local currency, or the baht, or whatever. So there you go. But I was going to talk about buying at auction. If you're buying at auction, just be careful. Make sure that you read all the terms and conditions and special instructions, and make sure your solicitor really understands auction purchases, because you need a really good solicitor. In my next podcast, I'll be interviewing a solicitor that specialises in auctions, and you probably need a specialist broker, or you need a broker that really understands getting finance together for an auction. And that could mean a bridge, first of all, and you need rapid finance, because when the hammer goes down on an auction, you've got 28 days to complete. Okay, usually, unless it's an extended completion. This is where you've got to read the conditions. Some could be lower than that. And then there are modern auctions where the buyer is paying the fees, and that can be quite expensive. So you've got to allow for that if it's what's called a modern auction. And even in some of the auctions now, you find that the buyer is paying quite hefty fees, £2,000, £3,000, £4,000 in fees just to buy the property. So just look out for all of those things, especially if you're buying in an auction. I think I just wanted to mention Section 24. I go to property events all the time, and I'm still meeting landlords that are stuck in this Section 24 tax trap set by George Osborne, who allegedly has got his assets abroad in trusts, and he set this tax trap for landlords who cannot offset the interest on their mortgage payments against their tax like any other business would, and this is where the property is in their own name and they're doing their own self-assessment, so they cannot offset the interest. Now, it doesn't matter so much if you're a basic rate taxpayer, but if you're creeping into higher rates of tax, which is not that difficult nowadays because they've frozen the threshold, so more and more people are getting into higher rate tax, then a lot of landlords are finding, well, hold on a second, the amount I'm paying in tax here and then the interest has gone up, I'm losing money on this property. Some are losing hundreds a month per property. But then if they want to sell it, they've got to pay capital gains tax. If they want to transfer it to a limited company, which would give them the tax relief, it will cost them money on capital gains as well, stamp duty, all those things. Now, there is a way of avoiding it. Now, there's lots of weird and wacky schemes out there, but I deal with a firm of accountants that specialises in property tax, and they give good solid advice. They give no nonsense advice and tell you this is what you need to do. This is the process to legally avoid paying those taxes, and they've done this before. It's a proven method. Nothing wrong with it, nothing dodgy about it. But if you need to speak to them, they will give you a free consultation on Zoom, and this really will apply to people who've got really not just one but probably 3 or more properties in their own name, and they're higher rate taxpayers, and it's costing them money. And it's good planning for the future anyway to have them in a limited company, especially where you're passing on a legacy or you want to plan for inheritance tax. It's definitely a good way of having the property by having it in a limited company. So if you want to talk to someone about that, get in touch with me, and I'll put a link up to a video I did with Siddharth, the accountant, and have a look at that, and then just drop me a line, charles@charleskelly.net. It's well worth looking at that. And if you want more tips on money, advice and that sort of thing, and not advice but tips on money, then check out my webinars on a Wednesday night, 7 p.m, where I go through 3 steps to money management and building wealth for your financial future so you can become financially free. Okay, thanks a lot. This is Charles Kelly. Let's hope that these Bank of England fools who sit up there in their ivory towers will bring rates down. Because I remember them saying, well, we need to get when inflation was at 8-9%, we need to get it down to 2%, then we can start reducing interest rates. Well, where is it? Come on, guys, where is it? We should be rioting outside the Bank of England saying, get rates down. We should be shouting them as they're going into their offices. I mean, these Just Stop Oil people, they're spraying paint on Stonehenge. They should be spraying, I won't say that, I might get arrested for that. But, we should be diverting our anger towards these people because they are really holding us like that to get inflation down. The inflation which they helped to cause by all this money printing that they did, and leaving our economy in such a mess that now, the interest payments are costing us just, unreal figures, 300 billion of debt on just for the spending on that period where we couldn't go out. But the national debt for the country is over 2 trillion. The US has got something like 35 trillion national debt. Their debt repayments now are more than the annual debt repayment they pay on the bonds and the loan and that sort of thing they've got is now more than the defence budget for the country. It's like living on a credit card that you can't pay back. So you get one of those other credit cards to pay that one off, and then you have an interest-free period, and then you're starting again. Then you get another one to pay off and another one. And that's what they're kind of doing, or they're just rolling the debt forward. And the difference is with the banks compared to us is that they can just print the money to keep making the payments. But what happens when you keep printing money? What happened to the Weimar Republic in Germany? What happened when Argentina just kept printing money? What happened when Venezuela kept printing money? What happened when Zimbabwe kept printing money? Their money became worthless, right? You know, a wheelbarrow full of money would not buy you a loaf of bread. The wheelbarrow was worth more than the money in it. That's an old cliche, but it shows you how you can keep devaluing and devaluing the value of that currency. Okay, because currency is just paper money. It's fiat currency, fiat money. It's just it doesn't even give you anything really. There's no backing for gold with this money. The money used to say the bearer of this note can ask for the equivalent amount in gold and go to the Bank of England and get the gold. Similarly with the dollar. The dollar used to be backed by gold, and you could go to the Federal Reserve and say, I want my gold for this currency that we're holding. And when the French government sent one of their not their tankers, their ships, their military ships, their naval ships to New York to collect their gold. They wanted their gold, they didn't want the dollars anymore. They wanted their gold in the early 70s. And of course the Federal Reserve had to give them that. And it was then that Nixon, they used to call him Tricky Dicky, right? He took the gold off the gold standard. And that's when I think the dollar has started to go downhill. So if you think about it, this is just a currency. This is a silver dollar. You could have a gold one as well. You could have a gold coin, a gold sovereign coin, or a gold eagle. And this is the real value. In 10 years' time, what will be worth more? This £20 note or this? I mean, at the moment, you would need, let's say, 2 of these, right? You'd need that much to buy one of these, roughly. If you're buying one off, you get them cheaper if you were buying them in bulk. But let's say £40 compared to that. In 10 years' time, what will this money be worth? I don't think it will buy you a lot. This will still buy what it buys today. So that's the analogy there. Gold from 100 years ago would buy you a certain amount of stuff. It will still, that similar amount of gold will buy you the same amount of stuff. Obviously, the stuff is different now. It's very difficult to compare, but it's held its value. It's a store of value. I can't get an income from this. It's not like a property or a share, but it will hold its value over time. So I always recommend that people should think about keeping a proportion of their wealth in gold and some silver, because I think, especially in times of trouble and when there's a crisis, I think that's when these things tend to really shoot up in value. Now, they can go down in value as well, but over the time, if you look at charts, you'll see that over time they have gone up quite substantially. So that's just a little tip there. So join me for my webinars during the week, usually at 7 p.m. most Wednesdays. I'll put a link up for that. And for landlords stuck in the Section 24, George Osborne, kicking the nuts, tax trap, check out that link for that video you can watch. And if you need help, immediate help, you want a consultation with a chartered tax advisor, chartered accountant, email me at charles@charleskelly.net. Okay, thanks very much indeed, and I will see you soon.